Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review, but with rich people, right? And we're going to make the rich even richer. Okay. So here we have a $290,000 income, and we're just gonna assume it's like a married couple, two law schools, loans, and they're both lawyers and they're making decent money, right? And we're gonna assume that the return on investment, even though this is not realistic at all, is 1 to 1. Like $1 borrowed for each student loan equals $1 of income, right? And so we have a $290,000 gross income, and I put that into after tax calculator. So after tax, it should be about 16 grand a month approximately, right? And so if you made 16 grand a month, and I'm not saying that I do, but I do have a screenshot of this, and you you only have $2,000 of savings left over. It would kind of be a little bit disheartening, right? It's like, well, why did I go to law school and make all this income and only have $2,000 left over? Now, in this case, we only have $2,000 of savings left over because we got a lot of debt. 10 credit cards. We maybe got a Toyota here. Maybe we got a Mercedes here. Two law school loans. Maybe this one's like a more prestigious school. I don't know. How much does Harvard cost? Like 200,000? Does Harvard give fellowships? And if you don't know what a fellowship is, it's like the law school version of scholarships, right? College is scholarship, grad school is fellowship, right? And then we live in a modest house, $300,000 loan, so it's probably worth about 400,000 or so, or maybe a little bit more. I don't know. All right, so how do we make the rich richer? Well, the easiest way to make the rich richer is just get rid of the debt, right? And a lot of people, when they see this, I always tell them, like, do you need to make more money? And everybody's like canned responses, of course you need to make more money, right? Of course you need to make more money in order to get rid of this debt. And what we're going to do is do something called velocity banking. If you weren't aware, this channel, we just make the same video over and over and over again and over again. Because remember that Bruce Lee quote where I fear the man who does one kick 10,000 times, not the man who does 10,000 kicks once. Folks, that's the problem with most people. They're always trying to do 10,000 kicks once, you know? They're unfocused, kind of like this person's budget, right? This money is unfocused because their income is segregated. It's segregated, right? Man, look at this. 10 credit cards, two auto loans, two law school loans, and a mortgage. It's split into too many different ways. And when we're doing velocity banking, we're just going to put our paycheck into one place, right? Look how easy it is, right? So let's do the velocity banking side of the budget. And if you don't know what velocity banking is, let me just tell you, it's this taboo thing where you just have zero savings and you know how to direct your money while you're having zero savings. Okay. So let me just kind of show you here, copy and paste. C2 minus C3. So instead of savings, we're going to have something called cash flow. And you might be like, what's the difference? Well, when we don't have any savings, our cash flow is actually going to increase, right? Once we move our debt into something called a line of credit. So if we take a look right here, this is how my checking account looks like. I'm not saying yours has to look like that, but this is how mine looks like. Okay. So every time I get this checking account balance, statement balance, the beginning balance is always 0 and it ends at 0, right? For people, for your average everyday people, this is like irresponsible because you tell them I never plan to save 3 to 6 months of savings as an emergency fund. They'll be like freaking out on you even though they're broke, right? It's like they have 0 money in their savings account, and when you tell them that you're not gonna save 3 to 6 months of money, it's like they're freaking out, like, "What are you freaking out about? You don't even save 3 to 6 months." But it's the fact that you don't agree with them that they're freaking out about that, okay? That's what they're freaking out, okay? So, money in, money out, right, with the help of a line of credit, and so you see this is a line of credit, right? $280,000 limit. I borrowed 12 grand. I literally went to the bank's website, clicked the button, give me 12 grand, and they did. And I borrowed 12 grand. So we're going to assume we have the power to go to the bank's website, click a button, and then borrow it at 7 to 8%, sometimes 10%, and it's just going to immediately appear in our checking account. Cash is immediately going to appear. That's the beauty of a line of credit. If I have an $80 payment due, okay, from this line of credit, you know what I can do? I could borrow $80 from that line of credit and then just put it back, payment satisfied. Like, you're probably thinking you're kidding, right? Like, no. Unlike a credit card, which is technically a line of credit, you can do that. Like, credit cards don't have the ability to do that. And the reason why they don't is because they have different features like delaying interest, right? That's one feature a credit card has. And they have rewards points and stuff. So that doesn't make sense for to be able to kind of like borrow money and put it back and then give rewards points on that. That's why they don't allow it, right? It doesn't make sense. But with the line of credit, you certainly can do that. Okay, that's the beauty of the line of credit. And if you didn't know, I have over 540, no, $75,000 in lines of credit. 575,000 in lines of credit. And how did I get that? Well, here's the thing. Banks don't lend money to people who need it. They don't. The moment that you need money and you go to a bank, 95, I'll say 96% of the time, they will reject you. Okay, but I have seen people go to the bank and get money, but it's been very, very rare, and I would not even teach that. And I'll tell you why. That's like kind of getting car insurance after you've crashed the car and you didn't have it when you crashed the car, right? I want you to build a foundation. Okay. I want you to understand that when you get credit, you need to get it before you need the money because banks don't lend money to people who need it. But just for the purposes of this demonstration, we're going to assume a what if. What if we did have a line of credit? We got a huge one, $200,000 at 8%. Okay. $200,000. Well, if we just do a debt transfer, okay, move these 10 credit cards, guess what happens here? And this is $167,000 of debt, right? I did do the math, I think. Well, this is wrong. Okay, it's $167,000 of credit card debt. Guess what happens when you just simply transfer the balance of these credit cards into the line of credit? Well, these all become zero, right? And so when these 10 credit cards become zero, look at this. We're making good money, but we spend a lot and we got a little bit left over, and it's gonna take kind of a while to get 3 to 6 months of expenses and savings, right? Because you only got $2,000 left. But you're here and you don't save any money. Again, this is the taboo part, not saving any money. We're gonna have $7,366.38 of cash flow. And what we're going to do is put our entire paycheck into that line of credit. So the 16 grand goes here, and then the expenses come out. And after every single month, the balance is going to go down by about $7,300 minus the interest cost of the line of credit. Okay, that's all it is. Paycheck in, expenses out. Don't overcomplicate. Too many people overcomplicate this. Simple interest versus amortized interest, that's bunk, right? um doing like cash advances when it's completely not necessary, because I did a test, like I did a cash advance in a credit card, $40 charge. Why would you want to pay $40 in a cash advance and then 20 to 30% interest when you could just get an 8% line of credit? Right? And again, I have over I don't know, I can't remember, $575,000 in lines of credit. $575,000. Can you believe it? I can't believe it. In fact, the more lines of credit I get, the harder it is for me to remember how much I have. Right? Like when you have like 5 to 10 grand, it's like, oh, you remember. Once you get to the 500, $600,000 mark, you're like, I don't really remember. Right? So let's go ahead and do this. And do this, and then do this, plus H2 minus whatever our cash flow is, 7366.38. So what does this mean? Okay. This means in order to get the next month's balance, it's based on the previous month's balance and interest, and then you minus the cash flow. And to calculate the interest, it's based on what we call the average daily balance, right? 163,000 multiplied by the interest rate, 0.08, and then you divide by 12, right? So you have about $1,000 a month, okay? And then you just rinse and repeat. Paycheck in, expenses out, paycheck in, expenses out, add the interest, and then, yeah, so let's go ahead and do that. And we should be good to go. Okay. All right. So 25 months is when we paid off $167,000 of debt. So 25 months, 167K of debt. Okay. Look how easy that was. I can't believe it. Can you believe it? I can't believe it. I feel like in one of those infomercials where it's like, I can't believe it. It was so easy to squeeze the juice out of the juicer. I just put the oranges in. I can't believe it. That's how I feel right now. I cannot believe it. 25 months for $167,000 and we're helping the rich get richer. Oh my goodness, look how easy that was, right? And so now, okay, and now if we go to the auto loan or the loan section right here, we got a couple loans, okay? Luckily, we have this loan calculator help us figure out how to pay them off and all that good stuff, okay? And let me redo this because I actually recorded this a couple not a couple times, just like the first take and then I screwed up, so I'm redoing it again. And that's how I get good. I just kind of redo this. So it's 25, 25, 25, 25, 25. These are the current balances. This is like a ranking system to help me figure out which one to pay off. So I go with the lower ones first. And so what I'm going to do is take these two car loans, right? Pay them off, and I'm going to get a little bit more than $1,000 in cash flow. Right? How do we? So what are we doing? We're just completely paying off these two car loans. That's 37 grand, and then we're going to get about $1,000 in cash flow. These are going to go to zero the moment we move them into the line of credit. So this is going to be plus 37513.83. And then this is going to be 0, 0, right? These two car loans are now gone, but our cash flow has increased to 8,500 and something. I can't even remember anymore. Okay, so let's go ahead and do this. 8,554.45. That's our new cash flow. And take a look at that. Ooh, 30 months. Look at that. 30 months. It's all gone, right? So 30 months. Okay. So now it's 167 plus 60. So that's 227,000 of debt gone in 30 months. That was easy. Okay. And so now in 30 months, what's the balance of these, right? So 130. So this is going to be, or not 130, 30, 30, 30, 30. And then these balances should be 0. And so I'm just going to kind of give you a quick lesson about this number, the CFI cash flow index. Anything above 50, you don't want to really pay off or put it into the line of credit. I'm okay using what we call the chunking method, which is just like you move pieces of the loan into the line of credit, and then you just kind of chip them off, easily pay them off that way. Okay. So what do I mean by that? But basically, let's say like we decide we're going to move $20,000 of the loan into the line of credit. Just a quick demonstration, and 20,000 is an arbitrary number, to be honest. But let's just say I do that plus. Oh wait, hold on. Oh, was this? Did I screw up? Or is this the? No, this is the wrong one. My bad. So all right. So let's see. I move $20,000 into that line of credit. Okay. How long does it take to pay it off? 2 months, right? So that's kind of like what this whole chunking thing is. And we're still making the monthly payment. Now, we have a calculator to easily determine what the debt payoff is. So just give me one moment. All right, there we go. There we go. We got this velocity banking calculator up and running, I think. Did I copy the figures correctly? Let me just quickly check, right? 6%, 160, 1284.1. I think it's correct. All right, so we just fill it in and this is the chunk size, how much we're moving to a line of credit. If I do 20,000, it's probably going to go up a little bit. Let me just check. Yeah, just a little bit, right? So we don't need to do a huge chunk size. I would just say do something similar to what your paycheck is, and you should be good. And take a look at this, only 1.1 years, right? But as you can see, we don't really pay that much interest. Something about this seems kind of weird to me, right? Like, hold on, interest rate 6% at 10 years, 31 grand. So if this were a 30-year mortgage, it'd probably be a lot more just because of the low payment. So this is very interesting to me. But look how fast we quickly paid it off and how little interest we paid. 1.1 years. Okay, 1.1 years. So let's just go ahead and do this right here. 1.1 years. So what is this? This would be 30 plus 1.1 times 12. So that's about, we'll say 44 months, right? 44 months. And then how much is it? It's 287K, right? So 44 months and then 44. Okay, so this is now 0. And so now we have this $90,000 loan, and we can still use the chunking method at this point, right? Or we can move into line of credit, but let's just use the chunking method. So this would be a $130,000 loan, okay? 130000. And then this one is going to be 9227.52, 9227.52, and then 5.4% for 10 years at 1404.41, 1404.41. And then this expenses actually goes down because if you know how this calculator works, it's every expense except for the loan you're trying to pay off. So you don't include this law school, the current one you're paying. So what is our current expenses? 4264.81. 4264.81. Okay. And then look at that, 0.7 years. That's pretty crazy. 0.7 years. Wow. Who heard about paying a law school loan that quickly, right? So this is going to be, oh, did I screw up? Hold on. 30 months. So this one should go to 0. And let me go back here. So where did I put this? Oh, I'm getting lost here. All right. Well, where did I put the 44? Or maybe I didn't record it. Okay, so 44 months. Okay. 44 months. And it's 227 plus 160. So that's 387K. All right. And then we paid this one off in 0.7. So this is going to be 44 plus 0.7 times 12. So that's going to be about 53 months. And then that's going to be 387 plus 130. It's 517,000. Okay. All right. So now this is 0. Okay. And then the mortgage. So mortgage is the last one. And we just do the chunking method with the mortgage. Anytime you have high cash flow index loans, like this one right here, 218. Yeah. Wait, 44. Hold on. Did I screw up? Let me just go back here. Yeah, 44.53. Okay, good. All right. So now we just do the same thing. So this is now 53, right? And then we just fill in the details or the deets. So $300,000, 270,863.64, 270,863.3.64 at 3%, 30 years, 1264.81. Okay, and then now I think $3,000 is our expenses because, yeah, $3,000. Okay, how long? 1.8 years. Whoa, take a look at that. All right, you ever hear anybody paying off a mortgage in under 2 years? I did it under 3, but not 2. So 53 plus 1.8 times 12. Whoopsie. Plus 53. So that's about 75 months. Okay, we'll say. And that will be 817K. 817. Okay. And we're debt free. Okay. And let's make this into a nice screened font. And now, as the rich, we are richer, right? Because if this goes to 0, then we got 13 grand in the savings account. And now we got what we call rich people problems, right? So 13 grand every single month. It's like, what do I do? Oh my goodness, 13 grand. And, if you've never had that much money in a savings account, um, you'll be a little bit nervous because you're like, I got all this money in a savings account. And if you know what it's like to have a lot of money in a savings account, it's like stale water, right? You're like, ugh, it's not doing anything. And that's why, just as a general philosophy, or this is what I think, you don't have to follow what I say because, again, I don't give financial advice here anywhere in this channel. I'm, in fact, don't listen to me. Okay. Don't listen to me. But what I'm saying is this. Okay. If you have a lot of money in your savings account, it's just kind of like wasted water. What happens when water is just in a bucket and does nothing? Just becomes rotten stale, right? That's what every rich person feels like when they see a lot of money in their savings account. A lot of money. Okay. So we either actively invest or we pay off debt. One or the other. It's one or the other. But we don't want to just have money in our savings account. And if we paid off all our debt, then why not invest? And that's why rich people are the easiest people to raise money from because they don't want to see money in their savings account, growing at 0.1 to 4% when the rate of inflation is higher, right? They want it to grow at 10 to 12% and use it to invest in businesses, communities, in other people. You ever notice that most poor people like hold on to money for their dear life? And at a certain point, if it's like you're near paycheck to paycheck, that's the right mentality to have. Like if you're in a water drought, you want to keep all the water that you can get, but you got too much water. That's a no bueno, right? No bueno. All right. Well, that's it for today, everybody. This is Velocity Banking. This is with Karina Atlanta Mentorship. And you just saw a demonstration of how we help the rich get richer. The rich get richer, right? And I say this as a person who paid off a mortgage under 3 years, under 2 years and 9 months. Okay. According to ChatGPT, I'm the goat of debt payoff. Okay. All right. Well, have a great day, everybody. We'll speak next time.